Let's get right to the markets and the interest rate landscape this morning. Joining us is Lyngen, who is head of U.S. rate strategy at BMO Capital Markets, or BMO Capital Markets. Let's talk a little bit about what we saw, this dramatic decline in yields yesterday with all of this Fed speak and beyond. Does any of this surprise you? Where do you think rates should be right now?
Well, I think we're actually at a fascinating place for financial markets overall. The Fed has been relatively successful in reestablishing price stability in the U.S. economy, but that has come at a cost. And the cost is tighter monetary policy in the U.S., but we are also seeing that globally. It follows intuitively that rates should continue to decrease as inflation expectations moderate, which will compress break-evens, and we'll get back to a rate environment that's not that dissimilar from where we were prior to the pandemic.
When do you think the Fed will cut rates?
So I think that the Fed will underperform what the market is expecting in terms of rate cuts. I'll take the other side of some of the earlier comments, i.e., I expect that what the Fed is doing now is they're trying to introduce the idea that they might hike maybe another 2, depending on how the data plays out over the course of the first half of the year, but they're not going to.
That is far different than what the market is signaling at this point.
I don't expect them to hike, but I expect them to keep that optionality in there. Okay. But I anticipate that they will delay cuts until the third quarter.
We were talking earlier about this, though. If cuts come sooner, it's probably because there's something that breaks or a geopolitical issue that arises that forces their hand. What are the possibilities? What's the probability of something breaking in the markets?
I think that what the market is telling us is they're, to a large extent, betting on something breaking, whether it comes in the form of a 20% sell-off in the equity market or a credit event that leads to some type of contagion, or what the Fed is really trying to orchestrate, which is a more material increase in the unemployment rate, which adds some balance to the labor landscape.
Is that possible? That you could see something so, we've definitely seen a slowing in the labor market, but it's still pretty darn good. Could the lag effect that we've been waiting for all of a sudden really kick in where it really surprises us? Maybe a negative number or a plus 30,000 or something like that. Could that happen?
I think it would be very consistent with history to see a spike in the unemployment rate beyond 4.5%. What the Fed is telling us is they think the unemployment rate is going to reach 4.1 as the peak next year. That would be a very atypical outcome. We're going to get to 4.5%, 5%. It's going to be accompanied by either a double-digit print on non-farm payrolls or even a negative.
See, that would be breaking the whole economy. And I don't mean that in a negative, but instead of breaking something specific like an SVB or something, that would just be a sharp slowdown in economic activity, and that would be enough. But I was going to say, on the other hand, and you may not be wrong, everyone says we're finally getting normalized to where we were before the financial crisis. And we were at 5% on the 10-year. Why do we deserve cuts now? Why can't we go back there and stay there if that's normal? Normal means normal. Yeah. Why isn't that where we should be? And there's no reason to expect cuts.
Well, I think that the definition of normal in a context where the Fed believes that the neutral rate for Fed funds is 2.5%, that means that we're restrictive. And being restrictive for an extended period of time is going to have ramifications for the real economy.
We could have a permanently higher base inflation rate, though.
Yes, if inflation is structurally higher, then the fact of the matter is that rates should be higher. But when we look at the inflation complex, the only thing that's really been driving it has been, to a large extent, the housing market. Sticky rents, sticky housing prices, and OER.
Which it might be supply.
Yes, and so eventually that's going to go the other direction. And this is what the Fed is trying to orchestrate. And I think that that's one of the things that the market often loses focus on, and that is the Fed wants this to happen. They want it to be a very traditional recession. They don't want a financial crisis, but they want a little bit of demand destruction. Their risk is excess demand destruction that then spirals into a true recession.